Standard Life's head of global strategy. Andrew Milligan's with us from Edinburgh now. Andrew, first of all, your thoughts on the Fed's second round of stimulus, QE2. Of course, we all knew it was coming. Many people saying that it was largely priced into the market. But how does it affect your thinking, your consideration when you're looking at where to invest?
Well, I think, as you said in your question, this has been a long time coming, and we've always got to say what is already priced into markets. And I think a large degree of the good news was already priced into the markets. The Fed was talking about QE from Jackson Hole conference onwards. They were giving very strong indications that the final sums would be in the region of 500 to 750 billion. Actually, I've been rather underwhelmed by the news from last night. The figure of 600 is definitely towards the lower end. It's time limited towards next June, although, of course, they could extend it. I wonder, actually, if we're not just seeing the last flurry of a little bit of leverage being put into effect into markets by investors towards year-end, and then we're going to see some profit-taking. The economic impact of this degree of QE on the US economy for next year is not going to be very material. Very few of the academic studies suggest that QE of this order of magnitude is going to have much of an effect on the US economy before perhaps 0.5% of GDP. Not unimportant in the consequence of an economy only growing at 2%, but it's hardly a game-changing degree for the US economy and therefore for profits at all.
Right, so a limited impact on the US economy, as you say. What about the markets, Andrew?
Well, as I say, the markets have already priced in a considerable degree of this. I mean, since the Jackson Hole conference, and I use that as a starting point, US equities are up way over 10%. And I fully accept that the earnings season has been good. But, for example, earnings are only about 5% or so ahead of what the consensus was expecting. So I think a large amount of what this QE will do is already priced in. The issue going forwards, I think, is really what happens to the currency markets. I mean, a number of people have been talking about it, your commentator a little earlier, and various others. If the US dollar does fall very sharply, then I think the issue we've got to start thinking about is commodity prices. There's already warnings from a number of retailers in the UK and the US about imported inflation as raw material prices have been rising for a whole series of factors. Add on to that the impact of a lower US dollar. Just at the time when Bernanke is hoping that consumer spending in the United States might be picking up, he might find a rather unexpected squeeze on disposable incomes.
And that's
from this
exactly
increase in
what we've been seeing,
inflation.
isn't it? We've been seeing a weaker dollar, and it certainly took a dip off the back of that Fed announcement. So, Andrew, with all this in mind, what are you advising clients to do?
We've been playing this short term. We think that a large number of more leveraged investors have been using QE as the argument to put money to work before the end of the year. I think we'll be seeing a run in markets for a few more days or weeks, and then I think we're going to be seeing a degree of profit-taking, and we'd warn investors, depending on their timescales, either to run with that little bubble that's appearing, or wait until markets have sold off and then start to put your money to work on a more constructive basis.
So corporate bonds still the way to go for you?
For the longer-term investor, I think you still pick up the yield that's very attractive that's out there. And one of the interesting things, of course, about the Fed statements is that they do want lower bond yields. I mean, we're seeing that already with the 2 to 10-year part of the curve squeezing down overnight quite significantly in response to this move. But that leaves other yields, of course, whether it's the yield in equity market, in commercial property, or especially the yield in corporate bonds, investment grade or high yield. That, I think, is the longer-term investment style for people to play into 2011, is look out there for the yield opportunities in a world where the Federal Reserve and other central banks are saying interest rates ain't going to do anything, and we want the yield curve to flatten quite considerably, will at least way out until the 10 to 15-year part of the curve, certainly.
Right, Andrew Milligan, head of global strategy at Standard Life Investments Limited. Good to talk to you. Thanks very much.